I love investing near where I live because you get to really see the impact of your dollars at work. But I think many beginners are taught to ignore their home markets and only invest in, the South or the Midwest where that, price to rent ratio on average is more favorable.
How are you identifying the properties? What strategies are you using to try and get that deal flow? You mentioned you don't need to evaluate 100 deals. You'll look at 5 and figure it out pretty quickly. But how are you getting those 5?
Welcome back to Peak Profits. Today's guest is David Holman, a multifaceted real estate investor, author, and community leader based in southern Maine. Dave's journey is anything but linear, from launching a bookstore chain in Bolivia to authoring 3 books and ultimately building a 94-unit investment portfolio over the last decade. He's a broker with Remax Riverside, deeply involved in his local community and specializes in multifamily, commercial, and investment property. Dave is also known for value-add investing without over-improvement, resident-first property management, and a strong belief that financing is the third pillar of real estate success. Dave, we are very excited to have you on today and have a conversation. Welcome to the show.
Thank you. Thanks, Brian. Thanks, Chris. Appreciate it.
Absolutely. And so you have, obviously with that intro, have done a lot of things over the last decade or so. We are very excited to get into it. We touched on Bolivia briefly, but now you're relocated to southern Maine. Can you kind of talk about, when you came back to southern Maine and when you started buying some of your real estate portfolio?
Sure. Yeah, absolutely. I grew up without any real estate background, went to college, majored in Latin American studies and environment and technology studies, which actually got me into the building space, green design, architecture, engineering, that kind of thing, kind of as an intro, whet my appetite for it. But I then went down to Bolivia. I had met a young woman who was then my girlfriend. Now we're married with 2 kids and several goats, who are also called kids, incidentally. And I just stayed there, and we opened a bookstore and camping store together. And then we wanted to get out of her home city. So we went as far away in the country as we could and opened another one. And then we needed one in between those for logistics. So we opened a third. And before I knew it, without any real training or classes, I was an entrepreneur and I had, 3 retail stores and 10 employees. And I just kind of made stuff up in Excel spreadsheets of what I thought I was supposed to do to track sales and expenses. And eventually in '09 came back to the US with my then fiance, and got an MBA because I thought I got to learn this whole business thing. And all I know is buy low, sell high, and you need a little more sophistication than that. Turns out I just needed to know accounting, and an MBA is not this magical degree that one might think it is. It's kind of a hodgepodge of different subjects. But I then went into the lucrative nonprofit space where I worked for 9 years until in 2015, my wife got pregnant with our first child, and I decided that my nonprofitability needed to be balanced with a little bit more, means for my incoming family to have a kind of full life. And so, I started studying the dark arts and decided that real estate it had like an unsavory reputation to me. It's like the icky landlord thing and the developer, where those things were not usually used in great context. But I realized that, from my green building days, I could make the world cleaner, less polluted, and a better place if I not only, converted my house to be, more sustainable, better energy systems and so forth, but got tenants to pay me to do it to their residences as well. And have used that model basically where try to drive NOI and higher profits by increasing energy efficiency, getting bills that are on the landlord to go back to the tenants, which ends up using a lot less energy. In all my buildings where there's a central heating system in Maine, you'd walk by in January, February, and you got like a 3rd floor window open because someone's too hot. And that's the wrong way to do it. That is not correct. That is the wrong answer. But, when residents aren't paying for their own heat or cooling, they don't care about that necessarily. But yeah, that, urgency of like, I'm going to have a kid and I'm working at a job that pays the bills reasonably well. I was at Bowdoin College doing development, aka fundraising work at that time, which is cool. I got to have, lunch with Reed Hastings and Netflix and meet all kinds of neat people and see their entrepreneurial journeys, how they kind of had become wealthy enough to donate, 5, 6, 7 figures to the college. And I had started my own little real estate portfolio by partnering with family who had extra retirement funds and I had extra, chutzpah and time and willingness to learn. So I just got into podcasts like yours and dove into them. Every commute, every lawn mowing, dish cleaning, every spare minute, I was listening to Bigger Pockets, and podcasts like Big Profits. And I really recommend to people, like, that's a great way. Learning in this day and age is often free. And I've gotten some of the best advice ever from just listening to the, battle scarred, cynical investors on these shows that have been there and done that. And, we make a lot of mistakes, so the listeners don't have to make the exact same ones. They can go out and make their own. So that's what got me into it. And eventually I completely ran out of family money. So I went to friends and then friends of friends. And before you know it, I'm a syndicator. And I sent you an old bio. I've got 360 units now, and we've got 183 in development. And some more in the pipeline. So, that's been a fun journey.
Wow. There's a lot to unpack there, Dave. You really went through a lot. So I want to bring it all the way back to your first property. Can you talk us through what kind of property that was? Was that a single family? Was it a smaller multifamily? Was it a larger multifamily? Like, how did you get that first property under your belt? And was it your primary residence at the time? Like, how did you get involved in scaling yourself up to over 300 units now?
Yeah, great question, Chris. And yeah, my first property was my home that we put a guest room on Airbnb, and we got to meet lots of interesting people from all over the country and world. Once we had a child, and we still did it after we had the baby, but pretty soon with an infant, it just wasn't comfortable to have house guests for them or for us. And we decided to stop that. But it was a great way to get extra income. And living in a kind of desirable tourist destination like coastal Maine, we were hot from like May to September, and then it kind of falls off a cliff in the winter months. But that definitely inspired me a bit. And then, partnered with family to buy a single family home as an investment property, and just said, I'll do all the work. If you can do all the capital, we'll split an LLC 50-50, which was generous of them in retrospect. I don't do all my deals quite that well now, but, and they've made actually better returns doing that than they would have even in the stock market and so forth, because we bought a home, pre-COVID, and I bought a lot of my things pre-COVID, and, anything that you've held on to since COVID should be up significantly. And if not, you did something wrong. So, I really am a great beneficiary of dumb luck and timing, but I think it's sort of like dollar cost averaging, which is a stock investing term, where you find the right thing, you do it consistently over time. Some years will be great, some years will be not so great, but over time, if you're doing the right things, you'll have a good average, a good batting average, so to speak. And that's the way it's worked out for me in real estate, where I moved kind of slowly. At first, I did a single family, then another single family. Then I kind of went on my own and did a mixed use building, which I didn't even know what that meant until my agent explained that to me. And he said, it's got a triple net lease. And I was like, what's that? And it said, well, it's a commercial tenant. It's an engineering firm, and they're paying half of your property taxes, half of your insurance, because they rent half of your building. And I was like, they'll do that? Like, tenants will do that? Really? Oh my God. Like, my residential tenants don't do that. So that was kind of an eye-opening experience. I think a lot of investors pick a niche and just only do that, which is fine. It's part of what I love about real estate. It's a huge tent. You can be successful doing anything. But there's a lot of people that avoid very interesting and profitable opportunities only because the wording is different. Triple net lease sounds all highfalutin and tricky, but it's a very simple concept. It's not that different from a residential tenant, and it's pretty easy to master with simple math. But it opens up a whole new sector of buildings and properties in your target market if you're willing to touch something. And mixed use has been a secret weapon for me, because I've gotten some of the best deals on multifamily by being willing to take that commercial unit on the ground floor. Yep. It's, oh, great. Well, you're getting 8, residential multifamily units up above it at half price, or, whatever, 2/3 price, because it's mixed in with this other unwanted hair salon or whatever it may be, that just made 90% of the investors completely write it off as, oh, it's not all commercial, it's not all residential, therefore, it's impossible, which of course we know is not true. And, I say it's all just, tenants paying rent. And they, we have big tenants, we have, commercial law firms and restaurants and office, users that have thousands of square feet, and they pay five figures in rent every month. And we've got, studio apartments and all kinds of different things. And it's all just, people paying for space on a monthly basis. And you need to figure out the norms and the ways to handle it. But in so doing, I think that's how I've been able to acquire a lot of things, is by finding great buildings that are poorly managed.
Yep.
Because the building is very hard to fix. The location, you can't fix the location. It's located already, where the days of jacking the buildings up on ox carts and moving them across the street are gone. Although a lot of our buildings in Maine did that in the 17 and 1800s. And I do own buildings from the 1700s that were built by Revolutionary War veterans. And believe me, there's maintenance involved in those. That's different from the modern ones, but you have to budget for that and make a plan and know what you're getting into.
That's incredible. And so kudos to you for really coming from Bolivia, where you had a great, relationship with your girlfriend at the time, and now settling in Maine and kind of growing all of this since. And that was about what, 2014, 2016 you had mentioned?
Yeah, I started real estate investing at that time. I did it as a side hustle for, about 5 years until 2019, when I was really, I've heard the phrase, riding two horses with one ass. I had two full-time jobs, and I needed to pick one because two is too many full-time jobs for a long-term setup. And I just loved real estate. It was very interdisciplinary. I'm kind of a dabbler, a jack of all trades, master of none. And it really caters, I think, to that kind of mentality for someone like me. And my other job was kind of office work, and it was desk work. And a lot of it was just spreadsheets. And I talked the Reed Hastings, the glamorous moments, but I didn't feel like I was really helping the world in my nonprofit jobs as much as I was in my real estate job, where there was a family that was homeless and they were living in a hotel, and we gave them a home, and they, were able to eventually buy a home, and things like that. We've taken people from homeless shelters many times, and that doesn't always work. I'm not saying, oh, it's a great success story every time, but I feel it has allowed me to really help people. And I'm not doing it as a charity. I'm doing it as a business, although I've lost many thousands being charitable in this business. But it's been a model that to me feels good, both for me and the world. And it gets me, waking up excited every day.
For sure. No, that's exciting too. And what you've built, I'm sure you feel a lot of pride about now. And you do this full time, and you're giving back to the community, but also building a great business for you and your family. And so there's a lot that I want to unpack based on your journey and what we've known so far. And we talked briefly off camera before we started recording here, where you've relocated to Southern Maine. And many people might think, that's not the prime real estate market, so to speak, right? It's not the Sun Belt. It's not the booming, Miami's or the Texas markets that you might see, or Arizona. And so you've really picked a niche where you had mentioned you really an hour drive circle of your town where you like to focus on, really honing in on becoming an expert and pro in that market, understanding, comps and prices and rents, and really zeroing in on that. Can you elaborate a little bit on how essentially you've done that and taken that concept and now built a 300 plus unit portfolio within that market?
Yeah, great question. And I love investing near where I live because you get to really see the impact of your dollars at work, and you can monitor them much better than if they're halfway across the country and you're just getting photos uploaded by a property manager. Not that that's a bad or unviable strategy, but I think many beginners are taught to ignore their home markets and only invest in, the South or the Midwest, where that, price to rent ratio on average is more favorable. And while that is true on average, many of those faraway people are not experts in the local, Kansas City market. And someone who lives in Kansas City can smoke them. And so I've just found that knowing the rents, knowing the pricing in my local market allows me to get good deals and know what they are. And I don't have to vet 100 deals to find a good one. I can find a good one in 5 or 10, it allows me to see things very clearly. It allows me to be a townie, which is kind of fun. To be able to walk out my door and very quickly be, seeing my money, investor money, at work, and having fixed up, historic buildings, aging buildings that were poorly managed, that were run, badly, and being able to take that pride of like having neighbors come to you and say, thank you so much, for what you did. I was like, I'm doing this as a for-profit business, but you're welcome. You're welcome for making money on your, neighboring property. But it really is great, to be able to do that for neighbors, to do that for existing tenants whose, work orders and maintenance items were often ignored previously. And we try to take care of them as best we can. And obviously budgets limit that to a certain extent. Not everyone gets a golden toilet, but, we try to make places safe and clean and have them look as nice as they can, per each property as appropriate. But I think the ability to do that in my home area is greater. And I think every market is investable. Even downtown Manhattan is investable. Buy and hold, like I do in Maine, may not be the easiest thing to find there. You might be better wholesaling or flipping in a very high priced market like that, which is a different strategy. But I mean, flipping one multi-million-dollar condo can put you on the map. I kind of crawled before I walked, before I ran, in a sense that I started with one single family home. It took me probably 6 or 8 months after doing that to even start thinking about the next thing. But these things have a way of snowballing if you want them to. I have friends who are investors who they DIY everything. They're never going to put anything under management. They're just going to do their own little thing in their spare time. And it limits their portfolio, but they're happy doing that. And I think that's fine. If it makes you happy and that's your strategy, do it. I'm a team builder. I love finding, people that are unhappy in their jobs and kind of sparking them with real estate and letting them kind of unleash their talents in ways that a lot of the corporate world kind of beats out of us. So I think it's a sector where, because the bar is often so low, other landlords do us the favor of setting that bar too low oftentimes, that we can come in as good landlords and property managers and really impress people, whether it's investors or residents in these buildings.
And Dave, when you've kind of drawn that circle within kind of that outer radius, how are you identifying the properties? Are you leveraging like a co-star? Are you driving for dollars? Are you kind of mailing out to people? What strategies are you using to try and get that deal flow? You mentioned you don't need to evaluate 100 deals.
Right.
You'll look at 5 and figure it out pretty quickly. But how are you getting those 5?
Yeah, that's a great question. And I'm an agent and I started that in 2019. And so that means I'm out in the market helping other clients to make investments. And, the key thing as an agent, like, don't compete with your clients. That's not really a great strategy. Help them, achieve their goals and put your own, outside of that. But I have actually never marketed in a serious way. I don't do it online. I don't do it in print. I don't drive for dollars. I actually just network and I buy things that are publicly listed. Some of my best, most profitable deals have languished on the MLS for years. And it is because they are poorly listed and they are poorly positioned. Like one of my best deals ever was positioned as an owner-occupant commercial building, basically. There was no rent roll, there was no leases, there was no investor information whatsoever. It's, hey, owner-occupant, come buy this 17,000 square foot office building. And I was kind of brought in as like a consultant to help the agent who was like the second or third agent, the poor agent that has to try to sell this albatross. And it became clear to me as I was going through it. I was like, wait a minute, the law firm that's in here now, are they renting from the current owners? They're like, yeah. I was like, well, what's the lease like? They're like $12,000 a month. I was like, and the price is $1 million? They're like, yeah. I was like, I might be able to buy this because they're only using half the space. And if it's already profitable with them paying $12,000 a month using half the space and I can rent the other half, like, hang on, it had been listed for 1,000 days.
Wow.
And, but it's just, again, it's about the perspective, and you have to visit these listings in person. I really want to emphasize that. Like, it's so helpful to go inside a building. And I say the worse the photos and the description, the more likely it is you might have an opportunity there, because a lot of brokers are super lazy and they don't do their homework very well. And I say that as a broker, unfortunately, my own beloved profession. But it's true. And they're not always positioning a property the way it ideally should be positioned. And whether on a small scale, that just means that a home that really could be 3 bedrooms was listed and priced as 2, and someone starting out can just grab that and unlocked $50,000 of value by this extra bedroom that they were calling an office or a living room, but it had 2 living rooms, or, things like that. Are totally out there in every market. Not every broker is a genius and does everything their job right. And I think, in the MLS, I'm looking at either things that are immediately listed. If it's a good deal, it's mispriced, you got to jump on it very quickly. I bought a former hospital in that way. I was like, ooh, wait a minute. This is only, I had looked at the deal several years prior when they wanted 10 million for it and they just listed it for 7. I think, and the rents are better than back when it was at 10, which I didn't take. I passed on it back then, but this might be a really good deal. And I jumped on it and it was. And luckily I got it quickly because other people figured that out quickly too. And so you either have to, something hits the market and it's mispriced, or it's a great deal or opportunity for you and you jump right on it, which involves a lot of preparation. Investors have to do a ton of work to be ready to make that offer and get it accepted. Or you wait, 90, 100 days until the froth has cooled off. And then sellers start changing their tune and they're suddenly much more negotiable than they were when you first approached them in that first month or two. If half a year has gone by, I mean, it could be a different family member in charge of it by that point, or who knows what's transpired in that building that might allow you, maybe they'll do seller financing when they wouldn't have before. There's so many things that can change when a listing kind of languishes that I think most people just assume it's uninvestable. It's a bad deal. It's no good. Don't touch it if it's been there. Everyone must have thought of this already, and they haven't. The longer it stays on there, the fewer people ever go and bother to check it out. Like there's this initial 30, 60 day look period. And if it goes beyond that, people just stop paying attention, I feel like. And that's when you can actually swoop in.
They're like, what am I missing here? Why is everyone passing on it? It must be
right. And maybe you find, half of those oh no, that's garbage. I like
yeah. Of course.
But some of them are
diamond in the rough.
Everything's a good deal for the right price. And sometimes that means they're basically paying you to buy it. But, I think with that mentality, you can find things in markets that are competitive or challenging or not the Midwest or South, if you're willing to really look at a lot of deals, be open-minded about where they come from. So for me, publicly listed things are great. And then networking, I work really hard to build a reputation as someone that honors my contract terms and closes my deals. And I don't play games with sellers. I don't try to nickel and dime them. I'll, make a request if there's a huge issue that's obvious and glaring that we didn't know about or something like that. But I think by building that reputation as, if you want a good buyer for your property who will pay a fair price, go to Bryan, go to Chris, he'll buy it with cash or he'll buy it quickly or whatever. I mean, that's a reputation that can be way more effective than a lot of the more labor intensive marketing techniques. If you know the right people, they'll bring you deals. I have attorneys that send me deals or clients. I have, bankers and people in my community that I've had lunch with and coffee with and just talked with and asked questions of. And they see me, as a local person that's trustworthy who will refer back and forth. And I think that old fashioned non-AI human dynamic, lo and behold, is still working in 2025. And I'm old fashioned that way, but it's been really, really helpful. And a deal that I'm getting under contract on today or tomorrow, I got that way, through my network and reputation. And it's like a whole block of a local downtown that's just prime real estate, A++. And I'm getting it at a great price. And I'm hoping to do a big development there because they like and trust me. And they could have sold it for more money. They could have sold it to other people. And, humans are funny. They choose not to sometimes. Yeah. So I think, I would just say guard your reputation, really try to build that. Whatever it is you want to do, just be a hardworking, honest, respectful person in this community, and good things will come your way.
That's awesome. Congrats. And obviously you've done it the right way. And so some of that is now coming back to you because of what, the effort and work that you've put in and relationships you've built and, what you've made of yourself within the community and what you're doing to the properties. I'm sure the tenants and everyone else, right, appreciates that. So they want to bring deals to you so you can, bring those full cycle as well and take those deals over that, might be struggling. And with that point in mind, you did talk about financing as being that third pillar. So we've talked about identifying and what you've grown. I'd be very curious to talk about your financing strategy and what that looks like, whether that be, mixed use or commercial properties. You started off as residential, and residential is pretty straightforward with 30-year fixed mortgages. There's some different products you can choose there, but pretty straightforward from a financing standpoint. But when you get to commercial real estate, financing changes a bit on what you're able to do and what they're looking at from an NOI perspective and how they're like evaluating and the property itself. So can you talk about how financing can be more of a strategic advantage to investors and what you're looking for and how you structure that?
Absolutely. That's a great question. And I started out, maybe naive is a kind word to use for myself, where I had a local bank and I went to them and they gave me loans and that's who I used. And I got like 7 or 8 loans with this bank before I kind of dawned on me that, wait, there's other banks. And I think one of the biggest lessons that I learned is like, this is like buying a car. You don't just show up to the lot and say, how much is that one? Okay, I'll take it. Like, that is wrong. This is a negotiation. And you don't just go to one dealer. You need to go at least 2 or 3, to get them competing against each other for your business. Like, you are the catch. So I would say to people looking for financing, like, you are the catch. They are going to make a lot of money off of you as you pay that loan. Comparison, price shop. I mean, don't be too brutal in the way you leverage them against each other and beat them up. But, I, at this point, solicit term sheets from 5 to 10 different banks, depending on the deal, and knowing like, oh, this bank doesn't want anything office, so I'm not going to go to them for an office deal. Oh, this bank loves multifamily and they're hungry right now. The other thing to understand is that banks have appetites just like humans that change. If that bank just had lunch, they're not looking for dinner right now, but then later you might come back and they're hungry. And so the same bank that gives you crap terms on one deal, 6 months later might give you the best terms on another. Don't necessarily write them off. To me, the loan officer is actually almost more important as the relationship. Date those loan officers, get to know them, because they are really key to your success, whether it's a residential 30-year fixed or even more so in the commercial world. And I'm using mostly commercial financing on deals, financing 70 to 80%, sometimes more. There's little tricks to that as well, where you can get increased leverage, it can be great or it can be dangerous, in a good solid deal that's pretty safe. I think that's generally an advantageous thing that gooses your returns. On a risky deal, you can blow up and go bankrupt that way. So, proceed with caution. But a lot of banks, for instance, will let you use at least 10% seller financing and then lower the amount of down payment you need from them to 10%. So if I'm getting 10% seller financing, I might only have to put 10% down on a commercial deal, whereas normally a bank would need at least 20. So that can increase your return significantly. And the seller financing, you can negotiate. And I almost always am, if I'm doing it at favorable terms. I don't want a 9% seller financing note. That's not helpful to me. I want a 4% or 5 or something like that. Many sellers are not interested. They want their money at closing and to leave and go away, and that's fine. But what I try to, put together is a packet for the banks. And I work with someone who's better at these things than me, both at the math and the presentation of it. They make a beautiful packet of all the numbers and information that the banker wants to see. And you do their job for them. Like, you underwrite the property for the bankers so that they don't have to do anything to take it to loan committee and show what a great customer you are, because you made a pretty packet that's 10 pages for them with all the location, the market, the rents, all the ins and outs, the DSCR, the pro forma, all in there. And if you don't know what that means, we can look it up later. But I think that is very helpful. And you get a bit aggressive. We ask for better terms from the banks than we think we'll get. One of the terms that people frequently don't know about that you can often get is known as IO, interest only. And banks will give you up to 2 years or more of interest only on deals where you're both acquiring and you're doing some renovations, or you're acquiring something that has a long lease up period, or there's some other kind of stabilization issue that merits the IO. Well, the IO just means that you're making like a 2/3 or half payment for the first year or two, which is very beneficial, for your cash flow and pro forma overall, and is worth pursuing, I think, in almost every commercial deal. There's just no reason why I wouldn't want to only have to do interest payments in the beginning, knowing that the property ought to be getting more valuable over time. I don't need to start paying that loan down right away. So that's definitely an important, facet. I'm getting a 30-year amortization right now on a commercial deal. And those are definitely achievable as you build your reputation and the deals get better, just like a residential loan. They're not going to fix the rate for 30 years. 10 is probably the longest most of us will get, as a fixed term these days. But, that's a really important strategy. As you get more advanced, you can get into what are called swaps, which is, some quantitative financial engineering that basically gives the borrower a lower rate, and it changes the way the prepayment happens, to kind of dumb it down because it's over my head sometimes. But I've done several larger loans with swaps, and that has been very helpful. And I did one 10-year fix at 3.2%, which was, I should have done them all 10 years like that, back.
Incredible.
I was lucky that I'd acquired enough stuff, in the late teens to early 2020s, that I did a lot of refinancing during COVID when rates were still low. Not because I was a genius and knew that they would go up later or whatever. I was ready to refi because I had added value, and my LTVs were getting down in the 60s, 50s, 40s, or in that kind of ranges, and wanted to, give investors some money back or do some repairs or what have you. And it was able to lock in a lot of, 3 and 4% loans in that time. I mean, now I was just like gobstruck that I got a 6.11. I mean, that was like really exciting. So I thought 6.5 was the best I was going to see. But I work mostly with local banks. The main banking community is really strong. There's dozens of good banks here, and they're often giving way better rates than the Wells Fargo's, Chases, and Bank of America's of the world, which I strongly encourage people to avoid like the plague. Like, unless you're doing a 9-figure deal, you really have no business going to those banks. Like, they will eat you for breakfast. They will foreclose on you. They care nothing about you or your life. And I've seen them be quite disingenuous with their bait and switch tactics. That's another thing to watch out for with banks. Much like car sales, they will do bait and switch sometimes, and that's why the loan officer and their integrity, and their ability to influence the bank is really key. Because they'll, as you bring good deals to them that they want to finance, they'll try to woo you saying, oh, we can do this, that, and the other with your rate and terms. And then when you get to closing, many times I'm like, oh, yeah, sorry. Yeah, we can't quite do that. And sometimes that's just a frustration and you go ahead, but sometimes it's like a deal breaker. I had to switch banks 10 days before closing because they increased my rate by 100 basis points. And I'm like, wow. I think it was 200 basis points. It was just something absurd. I was like, no, that's not the rate. We're not doing that. So, but the financing is so key. It's more important than the price because it's the monthly payment you're going to make for the years to come. And I would say, think of it as like the other price. There's two prices. There's the price you negotiate with the seller, but a lot of people get so caught up in nickel and diming and, oh, I need a $500, $1,000 off to make this work. Oh no, I won't buy it unless I get $5,000 off. When if you had just shopped for banks, you could have got $50,000 off. Like that is where a lot of money is made and lost by savvy investors who are really shopping for the best terms. That will have as big, if not bigger, an impact on your performa as your negotiation around the purchase price.
There's a lot of things, Dave, there that you mentioned that I'd never even heard of, including those swaps. So there's some homework for me after this to figure out what it really means. You did share earlier on that sustainability and things like that are very important to you, and you don't think that the only way to kind of improve value within a property is to kind of like over improve them. You mentioned gold toilets. I'm yet to live in an apartment with a gold toilet, but if you offer those, then that'd be great. Can you just talk a little bit about kind of what you're referring to as it relates to sustainability and kind of billing that back to the tenants and how that works to improve the value of those properties and ultimately increase the NOI?
Yeah, great question. There's two big factors or things that I do in historic, retrofits and existing properties. The biggest one that has the highest, NOI and profitability is the least sexy in the world. It's the most boring thing ever. It's insulation. If the landlord is paying the heating or energy bills, insulation is your friend. And often, any building built before the 90s, let's say, is going to have pretty piss poor insulation throughout. But where it really matters is where heat rises, which is the attic or the roof, assembly. And usually if there's an attic space, you want to go up in there and see what's happening. And that's where the unsexy, boring improvements that are pretty cheap can really pay off. You want to air seal around your pipe penetrations, which are often wide open, and you want to insulate it really well to get an R value of, 60 or higher. And rarely do you find that in an attic. So if you're in a hot climate or a cold climate, which is almost every climate at some point of the year, you can save a lot of money by focusing on that cap of insulation, which the common material to use now is cellulose, which is just, shredded newspaper mixed with boric acid. Bugs don't get into it. It's inert. It just stays there. And it's fluffy, pillow stuffing basically. But it's passive. It's a one and done. It'll last for decades. And it will save you money for decades. It'll save you like 30% on your energy bills for decades. It is a huge ROI driver. A lot of states like Maine have incentives to do it in the form of either a tax credit or a rebate, things like that. So look at your insulation, walls, windows, doors. Like again, look at the air gaps. You're not going to get a lot of bang for your buck by like getting a better insulated window or a door. Because again, heat rises. And as long as the air is not flowing in or out, in most rentals, that increased R value is not going to be a huge factor. In my opinion, I've gone through enough energy audits and they started saying the same things. I was like, okay, I get it. Basement and attic, in basements too, like, the top of them, the rim joists, you can often see daylight through them. You'll look and like, wait a minute. And if it's, February in Maine and it's -10 out, like that's not good. Your pipes can freeze or your heating system is going to be working harder than it needs to. So, those are again, one-time fixes that you can do. So that's insulation category, not sexy, huge ROI, and people should think about it. And I even sometimes do it when I'm not paying the energy bill because it's just the right thing to do. But I don't go nuts. Cellulose in the attic, air seal, and a few $1,000 and we're done forever. Then you get into energy systems. And that's kind of exciting and interesting and technical. A lot of people think like, oh, solar, let's all do solar. Like that's the greatest thing. I mean, even with the tax credits, which are expiring in like 90 days, that's not low hanging fruit. Solar is pretty high hanging fruit. You're becoming your own, power generating plant, which is great, but it's capital intensive and it's a slower payback. And you can't take it with you when you leave, and people aren't going to pay you 100 cents on the dollar, when they buy it from you, if you have solar. I've done it on a few buildings, but it's not to me a universal silver bullet. It's almost like a distraction. What I really look at are the heating and cooling systems. And Maine, unfortunately, has the highest rate of oil-based heating systems in the country, which are very dirty, bad for the environment, polluting, and they're super inefficient. You go down in any oil-heated boiler basement, and it's super hot down there in February with the air gaps because you're just wasting energy. Like a lot of it just gets radiated off as basement heat. It never gets upstairs. And there's huge price swings to it. Ukraine war spiked that. They're low right now, which might seem all well and good, but it ain't going to be that way for long, I'm sure. So I like going over to heat pumps where, you can decommission one oil or even gas burning system that was covering 4, 8, 10 units, put in a heat pump in each unit for about $5,000 a pop, which is a big capital investment. But, assuming those units have separate electric meters, you have now transferred your 10 or 20 grand a year of expense to residents and tenants and say, no rent increase this year, but you have to pay, your heat pump on your electric bill, going forward. And that can be a negotiation to make sure that it works for people. But in the long run, taking that 10 or 20 grand off of your expense ledger adds, 100 or 200 grand of value to your building. It's a huge, huge factor. It's well worth the, 30 to 60 grand you might pay to install the heat pumps. And usually you just need one per unit. The installers will come and tell you, oh, put one in every room and 3 in your kitchen. Like, no, like I'm heating a 1,200 square foot Cape house with one heat pump. I heated my own home for 8 years with 2. It's 2,000 square feet. I had no heat in the upstairs, and guess what? Heat rises. There's a lot of basic thermodynamics that we can use to our advantage. And a well-insulated apartment unit, one heat pump, just like a Renai heater or something like that, will provide the heating, and they provide cooling. They provide air filtering. They can dehumidify. They're kind of magical. There's a reason that Norway has 70% heat pumps now, and a lot of, hot and cold climates are going there. And the technology is getting better and better really quickly. There's new refrigerant coming out that's way more efficient than the old refrigerant. And those are just hitting the market now. There's a lot of good incentives for them in a lot of states. There's still tax credits. On the commercial side, those tax credits don't expire at the end of the year, I don't think. So there's some interesting things that people can look into that are not just Dave being a bleeding heart, tree hugging liberal. I have a lot of Republican friends that can do this too, in an advantageous way. because it's efficient. It makes sense. It's good business. Like to me, I look for those win-wins where it's like good for the environment, good for residents, good for business. If we can make that work, let's go in that direction.
Yeah, that's great. And a lot of ways to add value, not only to your properties, but to the tenants and, again, make everything more sustainable, more efficient, and doing it in the right way. And that's awesome. And so that brings me to probably our last topic today, but just based on our time, and we're covering a ton here. But the management aspect, your portfolio has grown, right, substantially over the last decade. You mentioned, I think we had it wrong in the intro, but 300 plus units now, you know, over a variety of, an hour or so, give or take, radius, a mix of commercial, residential. Like, how are you managing tenants? Do you have a portal? Do you have property management companies? Are you leveraging some stuff like that? And also managing your investor base, like how are you managing that as well? So I guess two separate questions: managing
Yeah.
your property units and then managing your investor.
Yeah, great questions. I've done everything. Which there's three options for management. There's DIY, which is how I started. I was the manager, I was the landlord till I got to like 32-ish units with a full-time job. And then I bought a small portfolio that kind of came with a manager, and I was like, oh great, built-in management. Like, ain't broke, don't fix it. I'll see how that goes. And I would meet with a guy once a week, and turns out it kind of was broke. Wasn't performing very well. Like, it was not his top priority to manage my buildings, and he was just kind of putting out fires, but not really getting A grades. And being an A student, this frustrated me over time. I want A grades, or at least Bs. Like, we can't be getting Cs and Ds in this management category. And one day when I found out that a tenant had moved out, not from my manager, but from the contractor who was like, there a week ago or something, I was like, wait, he should have told me that. And so I switched from that one to what I thought was a more professional company that was multiple people, went with them for a while. But again, the bookkeeping wasn't great. The timing, they were, not paying me on time. It was subpar. And again, I was getting C grades, and I really just wanted better grades than that. And I had a friend that, had worked, with a partner that had started his own management company. And he really explained it to me very well of like, it's risk management to have your own management company, because then you control when the vacancies get filled. You can drop the price directly yourself. But it's not like me personally doing it now. Like, we have a leasing director. So I started a management company back in 2019 with a partner from grad school. And that's now grown to 14 employees. And one of them is my director of investments and investor relations, and I'm really old school with investor relations, where a lot of it has been either meeting people face to face, friends of friends. That's probably 80 or 90% of it. Sometimes when I come on shows like this, someone will call or email afterwards saying, hey, I'm interested in investing, and that's great. And I just send out an old fashioned email, every 1 to 4 or 5 months, depending on how active I'm being and what I want to tell is going on. And that's how I, communicate with investors, or on the phone sometimes if they have questions or want to call. But, myself and Gene, our director of investments, work with them. And it's a very like untech heavy system. Our property management software is very high tech. We use Appfolio, which is a big enterprise suite that a lot of people have heard of. And that's good. It's a lesser evil than Buildium, which we started with. Sorry, Buildium. Buildium fans out there, their grass is greener. I don't know we switched from them years ago, like 3 or 4 years ago. So maybe they're better at marketing, or they're better at their product than they are at marketing now. But, Appfolio allows for an investor portal and login. We do our distributions quarterly that way. And we just are really open and honest with investors. And that's how I've been. And sometimes these historic properties have unexpected, capital costs. And I pause distributions for a couple quarters while we get them taken care of. And I sometimes have to loan them money to do that. And, that to me is really key, that I'm honest with investors. Not everything is always going to go perfectly and smoothly, like is advertised, and when it doesn't, I want to be upfront about that. But I'm also going to stand behind it. And like, I will get a part-time job at Domino's before I'm like losing people's money, because these are my friends and family in addition to other people, so I have deep personal sense of responsibility to make sure, these investments go well. So we've never lost money. We've never gone bankrupt. And that's key to me. I need to always be successful. And, even if I projected, 15% IRR and we're only averaging 12 or something like that, with good communication, I feel like investors can live with that. 12's not bad actually as an average. Luckily, we've actually averaged 30 or 40 for most of our, projects. And that's partly because I'm a genius. No, just kidding. But it's largely because we're, the right place at the right time. Like I've been investing before and throughout COVID. And that's just been a great time to be in the markets, with low rates and rising prices. And if you can just keep yourself cool and not go bankrupt and not get too exuberant, you can do well. And I describe real estate, it's a get rich slow scheme. You just have to slowly 5, 10, 20 years along, manage things prudently and it'll come along.
And you'll become Papa John before you lose any of your investors' money. So they love to hear that too. You're in it, to help them. Right. And to make sure that you're doing everything you can to protect their capital, which is most important.
Yeah. And most investors with me are repeat investors. Very few in any syndication are new investors, because they know me, they know who I am, they know I know Maine, and they know I'm doing good things in the community. And a lot of them care more about that than the money. I mean, that's the kind of investor I'm looking for. If all you care about is money, and you want the absolute highest max return, I might not be the right fit for you because I'm going to do things that aren't always as aggressively profit seeking as some other syndication operators might do. My opinion is that's actually going to get you a better return in the long run by doing the right thing and sometimes biting bullets that are uncomfortable to bite. But, we just put a new roof on a building that I didn't want to, and I tried to patch it for a year and we were playing whack-a-mole, and turns out, a 27,000 square foot rubber roof costs a lot of money. But we did it, and I loaned the property money. We had a few investors that loaned it money because, again, the bank did a bait and switch. We were going to do it with a bank loan, and they did a huge, long, protracted bait and switch. It made me crazy, leaving the bank nameless, but banks will do that. And at the end of the day, they just were not coming through on what they had dangled. And I was just kind of like, enough of this. I can get a better rate probably from just offering to investors like, hey, anyone want to earn 7% and loan your own building money to put on a new roof? Because I can go to a different bank and probably get a 7% or 8% loan to do this CapEx, but I'd rather give you the return because we have a strong balance. We have a strong rent roll. We have a strong cash flow. We just need $250,000 that we're hoping not to have to spend. But, the original roofers were not correct in their assessment that, the patching would work. And, these things happen in real estate. When you work with buildings from the 1800s, like Maine's average building age is like 1880. And my portfolio average is slightly older than that. We have buildings that were, moved by ox cart to their current location in the 1790s. And they're doing well now, but you do have to expect some CapEx and some repairs. I think a lot of performas, that you might get from a seller, I mean, take it with a massive boulder of salt. Grains aren't big enough, I look at it, but I make my own performa. Like, yeah. You think you'll spend $5,000 a year in repairs. That's cute. I'm putting in 20 because I know it should be 20 for a building of this size. Like that's what I average. Like let's not pretend that you can get away with 5 on a big building. So, things like that, you have to kind of do your own homework, in order to get an accurate performa. And it's really hard. And luckily I've been wrong on the upside more than on the downside. So that's key, to be conservative in your underwriting so that you're likely to outperform. I mean, for me, investors, it's all about under promise and over deliver. Like I'll do my performa, my best guess, and I'll see like maybe a 16, 17% investor IRR, and I'll market 14. I'll say, I think I can get 14. And that way, if things go poorly and I only get 15, we're still happy. Maybe I'm being a little disingenuous or whatever, but I really think it's better to do that and be really conservative in what I'm putting out there and not have people be too upset than the opposite, where I see a lot of deals, they're pitching like 20 and 30% IRRs. I'm like, really? How are you? That's going to be hard. Like good. I mean, I've gotten those, I've done that, but I didn't think I was gonna at the beginning. Right. That's really hard to do. So I'll let you know the next one comes around where I really think I can do it. Because if I tell you 20, it's really 25, and it's exciting. But I think that honesty is key.
This has been awesome, Dave. I feel like we could probably sit here for another 2 or 3 hours talking. So we may have to get you on for a second episode. But before we wrap up, I do want to ask you. You mentioned there's a development coming. Like, what's next for you and your business? And where can people get hold of you if they are interested in investing in your 25% IRR that you just promised everybody?
No, Mr. SEC, I did not promise that. I'm working on 3 projects right now. One is a small historic infill where last night at the planning board we got approved to add 8 units to a brick building, on a downtown Main Street in a great shipbuilding community in Maine that gets big Navy contracts to work in destroyers. So that's a great community, great building that we're excited about. I've been working for the last 2 years, year and a half on a 183 unit apartment building syndication that we're doing in a neighboring town with a big incentive, a tax rebate called the TIF from the town to do some affordable housing in that project. And then just starting to get under contract on a really exciting one that I mentioned earlier, developing a whole block of a main street, that was a word of mouth reputational thing. And that'll be due diligence. I'm literally going to have due diligence for a year on that contract. And that's the kind of thing you sometimes have to do because it's a former dry cleaner site, which are always contaminated, and just doing the designs and engineering and pricing and permitting that a bank needs before they give you any money. It takes 6 to 12 months easily for big projects like this. So it'll be a little while. I've slowed down now that rates are high, but people can find me at holmanhomes.com. I'm still crazy in giving out my personal email and phone to people, and I rarely hear because I think people are shy, but it's Dave at holmanhomes.com, spelled just like it sounds. And my cell is 207-517-5700. I'm happy to have a quick conversation, introduction with folks and get to know you.
That's awesome. And we appreciate the transparency. And it sounds like you have a lot of exciting projects lined up and the portfolio and business continues to grow. So kudos to you on everything you've built over the last decade and the team that you've built out and what you're doing in the community. And we want to thank you and appreciate you coming on, but we will have you back on
I'll be
at
back.
some point, I'm sure, with all these updates that you guys have going and moving. So thanks for coming on. We'll share all that stuff in the show notes with our listeners, and don't be shy. Reach out to Dave. As you can tell, he's a very nice guy, and everything he's doing within the community up there in Maine. So Dave, thank you for coming on. It was a pleasure to have you.
Thanks, Brian. Thanks, Chris. Appreciate it.
Thanks, Dave.